Alright, just a quick note before we start. I have added a clickable list of topics covered in the video in the description below here. You can see the list of topics along with the timestamps here. So if you wish to jump to any specific topic, you can do so by clicking on the timestamp. Let's say in this video you wanted to directly jump to shifting of securities. So you can just click it here and it will take you there. The other useful way to navigate across topics is by hovering over the progress bar. It will show the progress bar split into various sections of the video. So different topics get highlighted when you hover your mouse over. So if you wish to jump to any section, you can do so by simply clicking there. Alright, let's get started. In this video, we are going to cover the following topics related to advances. We'll start with income recognition on regular accounts, and then we'll see what happens to this unrealized interest once the account turns NPA. Here DBNR will come into picture, which is the interest which was debited but not received. Then we'll see the reversal entries to this DBNR once the recovery happens. Then we'll have a look at the interest entries once the account is recognized as NPA. There we'll encounter this concept related to OIR, which is overdue interest reserve. Then we'll see the reversal entries of this OIR once the recovery happens. And towards the end, we'll see the EMI related concepts. We'll closely look at the interest and principal components of the EMI. And lastly, we'll see this very interesting topic related to recovery. Here we'll see what kind of considerations do the banks have when they choose whether the recovery should go towards the principal or the interest, and the implications of that choice. For now, you see interest has impact on the net profit, whereas principal has impact on the gross NPA. Alright, let's dive in. Let's first look at the income recognition on the performing accounts, which is done on the accrual basis. Let's say this bank lends an advance of 100 rupees to ABC company on the 1st of January 2020 at an interest rate of 12% per annum. So as long as this ABC company enjoys this credit facility, and interest will keep accruing on it each day. But as per the bank's policy, it will only become due at the end of the month. Although it's constantly accruing, it will become due at the end of the month. So let's say the month of January has passed. So what will happen at the end of the January, will debit this account of ABC company by 10. Because the interest rate was 12, for each month 1% becomes 10, so an interest of 10 was debited. Correspondingly, we will recognize this income in the P&L by crediting it. So under the P&L, we will recognize this income under the head interest income on advances and will credit it by 10. So same thing happens each month. It happens for the February as well as for March 2020, and correspondingly we'll keep recognizing this income under the P&L by crediting it each month. So at the end of the financial year, we have debited this account by 30 and correspondingly book an income of 30 in the P&L. You would have noticed that there is no cash that we have received so far, but we are still booking the income. How is that happening? It's happening because so far this ABC company's accounts is a standard asset. And on standard assets, we can book income on the accrual basis, meaning we can book the income as soon as we earn it, not necessarily receive the cash. Can we keep booking this income forever? The answer is no. Why? Because our IRAC norms say for a term loan, if either of the interest or principal remains overdue for more than 90 days, the account will be treated as NPA. And once the account becomes NPA, the income will be recognized on the cash basis and not the accrual basis. So we first debited the account on the 31st of January. So from the point we debited this account, the interest started to become overdue. So if we don't receive the payment for more than 90 days, the account will turn NPA. So let's say that 90-day threshold breaches for us on the 30th of April 2020. The account turns NPA. Once that happens, the first thing that we need to do is to reverse all the unrealized income. So in this case, we had recognized the 3 interest debits that we had made, aggregating to a sum of 30. So in order to reverse this 30, we will be debiting the P&L by 30 and creating another GL, which is called OIR, overdue interest reserve. So we'll credit this by 30. OIR stands for overdue interest reserve. In other words, this 30 was debited but not received, or DBNR. Just to reiterate, we can keep recognizing income on accrual basis as long as the account is regular or performing. Once it becomes NPA, we need to reverse all the income that we had recognized by debiting the borrower's account. In this case, it was 3 interest debits only. That is the interest for 90 days only, which was debited but not received. In other cases, it could be more than 3 debits. Why? Because here we could make the account NPA as soon as it became non-performing, as soon as it reached the 90-day rule. In other cases, let's say the bank doesn't have a automated system and recognizes NPAs on manual basis. So there are chances that it had debited the account for more than 3 months. So for all the months it had debited the account and booked income, all that income which was unrealized, once the account turns NPA, this income needs to be reversed, as this was never received. Now let's see what happens when we actually receive the cash. Let's say on the 1st of May, the borrower came and deposited a cash of 30. So we'll debit the cash by 30 and give the benefit to the borrower of this by crediting its account by 30. Thereby the balance will decrease from 1030 to 1000. And since we have received the cash, we can now book the income in the P&L. We'll do so by reversing this entry. So we'll credit the P&L by 30 and debit this OIR by the same amount. So in the NPA accounts, we recognize the income on cash basis. Once we receive the cash, we can credit the P&L by reversing the OIR. Now let's consider the scenario once the account has turned NPA. How would we now recognize the income? Now everything will happen on the cash basis. Let's say in the previous example, when the account turned NPA on 30th April, even after that, there was no repayment from the borrower. Now let's see what kind of entries are being done. So now that the account became NPA on 30th of April, for the month of April and all the subsequent months, we know we cannot recognize the income in the P&L. So neither will be debiting the account and nor will we recognize the income in the P&L. What we'll do now is we'll make some entries just to keep a track of how much of interest has accrued, so that we are aware at any point in time how much of the total interest has accrued so far that we need to recover from the borrower. We do that by creating contra entries. On the debit side, we'll call it interest receivable on NPAs and debit it by 10. Correspondingly, we'll create a contra entry on the credit side calling it as OIR and we'll credit this account by 10. So on each side we have an entry of 10, but the borrower's account and the P&L remain untouched. So no income is being recognized. We are just trying to keep a track of the earned income or accrued interest. So for each month, we'll keep creating contra entries. For the month of May, we'll again do the same thing. We'll debit the interest receivable by 10 and correspondingly create a credit entry under the OIR, which is your overdue interest reserve. So although the name OIR has been used twice here, we had previously used it here while reversing the interest booked in the P&L once the account turned NPA. So this OIR is essentially the income which was debited but not received, which is different from this OIR where we have never debited the P&L. It's just a contra entry. One thing we need to know about both these OIRs is that although their name had this term reserve, neither of these two is a reserve. Both of them are just simple contra entries. This 30 is a contra of the debits in the account of the borrower, whereas this 20 is simply a contra entry to keep a track of the interest to be recovered at any point in time. So neither of them is a reserve, and certainly they are not part of the own fund of bank in any way. These are just contra entries. So one thing that you'll notice here is that when you look at the trial balance of this bank, you'll see on the debit side the OIR balance is 20, whereas on the credit side the OIR balance would be 50, which is 30 plus 20. 30 being the part which was debited but never received and 20 being the contra part. So an important tip here is if you find these entries of OIR to be balanced on both sides, it would mean that the bank has not recognized this 30 or the bank has not reversed this debited but not received part. Hence the bank is still recognizing that 90-day interest or more than that, depending on whether it has auto NPA or manual NPA. So if both the OIRs are equal, we need to probe deeper and check some sample NPA accounts to see whether the unrealized debits were reversed or not. If the credit balance in OIR is more than the debit balance in the OIR, it means that there are good chances that the unearned interest or the 90-day interest has been reversed from the NPA accounts. If not, then we need to probe deeper. Now we'll see what happens to these contra entries once we actually receive some cash. Let's say in the month of June, the borrower deposits a cash of 20. So we'll debit the cash by 20 and correspondingly book an interest income in the P&L by crediting it by 20. And at the same time, since we have received this 20 that we were keeping a track of by creating contra entries, we can now nullify these entries since these due entries have been paid by the borrower. So we credit this interest receivable by 20 and we'll debit this OIR by 20 so that both sides become 0. So two transactions will happen. First is recognition of income by crediting the P&L and debiting the cash, and second is reversal of these contra entries. Let's compare and contrast advances as an asset vis-a-vis other assets like investments or fixed assets. So unlike these two assets, advances only generates interest income. It's very unlikely it will generate any capital gain. What I mean by this is, if I give an advance of 1000 rupees, so this is the principal that I'm giving, I will definitely earn some interest income on it and eventually I'll get my 1000 back as well in the process. But this principal invested will never increase in value. I would not be getting more than 1000 as recovery in terms of the original investment made, which is not the case with the investments in fixed assets. If I make any investment, let's say if I buy a government security for 1000, and since this is traded in the market, it is very likely that it may go up in the value and trade at 1010 and at the same time give me interest in terms of coupon. So I have two types of income, the interest income and the capital gain. Let's say for a fixed asset I bought it for 10,000. This can help me earn some rent income. At the same time, it might witness some boost in the valuation. It might increase to some 15,000 over a few years. So I'll be earning some rent income as well as some capital gain. So unlike these two investment categories, the advances is unlikely to generate more return to the principal invested. Why? Because this is not freely traded in the market. So my original investment remains fixed in value. So when I say this, I'm talking about typical loans that Indian banks give and not some asset-backed security or any structured product wherein even the advances or the stream of cash flows in terms of principal and interest is sliced and diced and made into a liquid asset which could be traded. The point I wanted to make here is that for advances, when you receive the principal repayment, there are very low chances that the P&L will get impacted because gains are unlikely on the principal itself, which is very much a possibility for an investment or a fixed asset. Okay, now let's look at some EMI related concepts. Let's say we gave a term loan to ABC company of 1000 rupees. So this is a term loan at 12% interest rate. So in term loans, you have a concept of EMI, which means every month I'll have to repay some interest and some principal. Let's see how the proportion of these two components in the EMI varies over time. Let's say the EMI is 15. We can see for the first month, since the principal outstanding is 1000 at 1%, for the first month I'll have a interest of 10, so the remaining will be principal. In the second month, you will notice that since we have paid the principal of 5, now the balance outstanding is 995 only. So the interest on it would be rupees 9.95. So we see a decline in the interest, whereas since the EMI is to remain at 15, the principal component has now increased to 5.05. So this is a simple example, but even if you do calculations in Excel, you will see in the loan amortization schedule, the interest component declines over time as the principal outstanding reduces, whereas the principal component in the EMI increases with time. Now let's quickly have a look at the accounting entries that happen. Let's say this loan was disbursed on the 1st of January 2020. So at the end of January, I'll be debiting the account of ABC Corp by 10, since the interest component in the EMI is 10, and correspondingly book an income in the P&L by crediting the interest income on advances head by 10. You'll notice that the account has been debited only by the interest component. So in the account statement, we'll only see the balance outstanding as 1010 at the end of January. You will see that we have only debited the account by 10, whereas the EMI was 15. Let's say the borrower deposits this EMI on the 1st of February in cash. So we'll debit the cash by 15 and we'll debit this account by 15. The balance outstanding remains 995. In this 15, 10 went towards settling this interest and 5 was used to reduce the principal amount. The outstanding balance becomes 995. You'll notice that nothing has happened to the P&L. Why? Because the income that was to be recognized, which was the interest component, was already recognized at the end of the month as soon as the account was debited. So when we receive cash, we don't need to make any adjustment since the recovery of principal never flows into the P&L. It's just the interest component. So just to reiterate the point, in case of term loans, both interest and principal become due at the end of the month. So you may only see the interest component getting debited in the account statement, but that's not the only value that we are expecting. We are expecting both the principal as well as the interest to be repaid. If either of them is not repaid for more than 90 days, the account will become NPA. This is in contrast to the non-term loans, let's say the CC loans, wherein only the interest becomes due, the component that we debit in the account, and not the principal. So as long as the interest is getting paid, we are fine. But in case of term loan, the whole EMI needs to be repaid. Alright, the last topic that we are going to discuss is the impact of the choice that banks make in terms of where the recovery goes, towards the interest or towards the principal. What are the various considerations and its impact? Alright, let's see what the circular has to say about the appropriation of the recoveries. It says, in absence of a clear agreement between the bank and the borrower for the purpose of appropriation of recoveries in the NPAs, that is towards the principal or the interest due, the bank should adopt an accounting principle and exercise the right of appropriation of recoveries in a uniform and consistent manner. So if there is no clear agreement between the bank and borrower in terms of where would the recovery go, towards the principal or towards the interest, in such a case the bank needs to adopt an accounting principle and exercise the right of appropriation of recoveries in a uniform and consistent manner. Let's say there was no clear agreement between the bank and borrower, and the bank has made a policy that it will first recognize the recovery towards the interest, then should do that consistently. It shouldn't be that for 1 year it recognizes this as interest and for the other it says it will go towards the principal. Whatever it does, it needs to be uniform and consistent. Let's say the loan of ABC Corp of 1000 rupees became an NPA and it had an interest receivable of 40. Let's say a month later the borrower deposited a cash of 30. Now let's see two scenarios. In scenario 1, the bank chooses to recognize the recovery as interest first. In scenario 2, it will recognize the whole recovery as principal first. In scenario 1, the whole amount will flow towards the interest. What will happen is that the bank will recognize an income of 30, and at the same time this interest receivable, which would be a contra entry, will get reduced to 10. In the first scenario, there is a boost to the profitability by 30. Whereas in the second scenario, if everything flows towards principal, you'll notice that nothing happens to the P&L. Only the principal outstanding reduces from 1000 to 970. The benefit here is that while there is no income to be recognized, the gross NPA level will come down. Why? Because the formula of gross NPA is the principal outstanding in all the NPA accounts divided by the total advances. Since the recovery is flowing totally towards the principal, this numerator will get reduced. So the gross NPA will come down. So you'll come across such situations wherein the bank had this policy of recognizing the interest first and had been doing so far, but all of a sudden it stops doing this and starts to do this. This typically happens when the gross NPA levels are breaching a threshold, let's say 7%, and the bank needs a permission to open a new branch. For that, it needs to fulfill the FSWM criteria, financially sound and well management bank criteria, which says that the gross NPA should be less than 7%. So far, since it did not have any such requirement of opening a new branch, it was following this practice so far. Why? Because it was getting a boost in the income. But the moment it decides to open a new branch, it realizes that the change in the practice is required in order to fulfill this criteria. So such practices are not okay and you need to be watchful for it. Whatever the bank does, it should be uniform and consistent. Uniform meaning all accounts should be following the same practice, and consistent meaning it should not change every year. Alright, the last thing that I want to discuss is the impact of recovery on the P&L. Let's say this loan to ABC company turned NPA and the principal outstanding in this was 100, whereas the interest receivable was 50. So correspondingly we had an OIR of 50 on the credit side. Now when a recovery of 150 comes, what will the impact on P&L? The first thing that will come to mind is that this 50 will flow towards the income as 100 will get consumed by the principal. Now let's discuss the not so obvious part. Let's say this account was substandard, and we know that for substandard we need to make a provision of 10%. So since the principal outstanding was 100, a provision of 10 would have been made by debiting the P&L. So when this full recovery of 150 happens, the P&L will get impacted by two things. First is the interest component of 50, and the second would be reversal of this excess provision of 10. So there will be net gain of 60. Here for the simplification purpose, I am not accounting for the provision required for standard advances. So it's not just the interest component, it's the reversal of the provisioning requirement that helps. And this impact becomes very prominent in case where the provision requirement was very high. Let's say if this was a loss asset, the bank would have made a provision of 100. And when the recovery of 150 would have happened, the impact on P&L would have been 50 out of interest and 100 out of reversal in provision. So a total impact of 150. One might even get a false impression that both the interest as well as the principal got recognized as income while the recovery happened, which was certainly not the case, as we cannot recognize recovery on principal as income. It was the reversal of provision which was 100 and not the recovery on principal which got reflected in the P&L.